Hi, welcome to another video in the AS A-Level Financial Accounting series. In this video, we are going to cover the second part of the ratio analysis. Just before this video was uploaded, we covered the first part of the ratio analysis. So let's begin with the topic, or let's continue the topic. So in this video, we're going to focus on three broad category of ratios. Efficiency ratios, that will tell us about the efficiency with which business operations are being carried on. Second, the solvency ratio. Solvency means the long-term ability of a business to pay its liabilities. So if you remember, in the previous video on ratios, we did the liquidity ratios. Liquidity is about the ability to pay short-term liabilities or current liabilities. Solvency is about paying the non-current liabilities or long-term liabilities. And then we'll have a look at some of the investment ratios. As investors, when we have multiple options to invest, or let's say we have to take a decision whether to invest in a firm or no, we need to use these investment ratios and then decide whether a particular investment will be worth it, whether it will generate returns for it, or whether the investment will not be a good decision. So these investment ratios may help us to come to a certain conclusion. So let's begin with the efficiency ratios. The first one is the net working assets to revenue. The ratio is calculated as net working assets divided by revenues into 100. What is net working assets? This is different from working capital. Working capital means current assets minus current liabilities. But if you see this net working assets, the formula, it is inventory plus trade receivables. So these two are from the current assets, and trade payables, that's from the current liability. So we are not taking all the current assets and all the current liabilities, just the net working assets, the assets and liabilities that are important from day-to-day operations point of view. So this ratio, when you calculate, you will get it in percentage terms. What does this ratio tell you? How do you analyze this ratio? It tells you how much percentage of revenue is tied up in the net working assets of the business. For example, if the revenues of the business is $100 and this ratio comes up to, let's say, 40, it means when you're generating revenues of $100, out of that $40 is tied up in inventory, trade receivables minus trade payables, or you can say net trade receivables. So the $40 is not currently usable as cash. It is tied up in the net working assets. So we can say that a very high ratio indicates for a business that a lot of amount is stuck or tied up in the net working assets, and hence it's not a very favorable situation. We want the assets of the business should be as free as possible. If most of the assets of the business are in liquid form, in cash form, then the business can use them as and when opportunity arises. If a lot of amount is tied up in inventory or trade receivables, there may be chances of obsolete inventory, and also if the debtors are not paying on time, and if that is the reason why trade receivables is showing a very high amount, then there can be chances of bad debts. Overall, it shows inefficiency in the management of inventory, trade receivables and trade payables. So compared to the competitors in the industry, a firm should try to have a lower net working assets to revenues ratio. Another reason is that if this ratio is high, then the owners, shareholders will have to pump in more money, or the firm will have to borrow more long-term borrowing to finance their net working assets. Otherwise, how will they continue their investments in the inventory, trade receivables? The money has to come from somewhere. So as the net working assets to revenue increases, then the firm may have to look at long-term sources of funds also, like raising money from shareholders, or taking long-term loans from bank and so on. So how can we improve this ratio? How can a firm improve this ratio? It can reduce its investment in the slow moving inventory items. If the inventory is too high, and the reason is that the firm has bought too many items which are slow moving, they've bought it and they kept it, and maybe in anticipation that when the customer will come for this item, we will sell it, but that is leading to a lot of amount being tied up in inventory. So that increases the storage cost of the business. There is loss of opportunity also for the business. So the firm can try to reduce their investment in slow moving inventory items, and also to ensure that the debts are collected efficiently. Whatever credit period is allowed to the customers, the money should come into the business from the customers within that credit period. Otherwise, aggressive steps should be taken to ensure that collection is timely. And the firm can also try to avail more credit period from the creditors, from the trade payables, because then that will allow it to reduce its investment in the net working assets. Because if creditors are allowing you a higher credit period, you will pay them later, and then you can use that fund or use that money for other operations of the business or day-to-day working operation expenses of the business. So that way also the net working assets to revenue can be improved. Then we have the working capital cycle. This ratio is also called cash conversion cycle. How do you calculate this ratio? So we take the average inventory period, which we saw in the previous video on ratios. It is the average period or the average number of days for which inventory is held before it is sold to the customers. Or in other words, it is the average period for which the business can continue selling its current inventory, before purchasing extra inventory items. Then to this, we add the average collection period from customers. So this is the average period taken by debtors to pay to the firm, minus the average payment period to creditors. So average time taken by the firm to pay its creditors. So, this ratio tells you that when some investment is done in the current assets of the business. How is investment done in the current asset of the business? Let's say inventory is bought. Then it is expected that the inventory will be sold to debtors. Then it is expected that debtors will pay us cash. So this entire cycle is called the cash conversion cycle or working capital cycle. This ratio is also called cash conversion cycle. So this ratio tells you on an average how much time the business takes to convert its original investment in the inventory into physical cash. It is calculated in days, obviously. So in those many days, let's say it comes to 90 days, it means when you invest in the inventory of the business, inventory could be in terms of raw materials to manufacture a product or directly buying finished goods to sell in the market. It will take 90 days for the firm to convert this money or convert this investment into physical cash. It means to receive cash from the customers and eventually pay to the creditors. So the analysis of this ratio is that a shorter working capital cycle is good for the business, because then it means that the business will have to put in less investment in its working capital, in its current assets or net current assets. If the working capital cycle is big, then more and more money will have to be invested in the working capital, and that will increase the need for the funds for business. So that completes our efficiency ratios, where we've seen two ratios that can analyze more aspects of efficiency of our business operations. Now let's go on to the solvency ratios. The first one under solvency ratio will be the income gearing ratio, which is calculated as the interest expense, the annual interest expense, divided by the profit from operations multiplied by 100. This will be calculated as a percentage. So what happens is, in a business, first you calculate the gross profit, and out of the gross profit you will deduct the operating expenses. Once you do that, then you get the profit from operations. And then from this profit from operations, first you make payment to the bankers from whom loan have been taken, or you make payments to debenture holders. So this payment is called the interest payment. So you make the interest payments to the bankers or to the debenture holders. Then if you have issued any preference shares, then preference dividend will have to be paid. And finally, whatever profit is left after meeting these two payments, then that is left for the ordinary shareholders or equity shareholders. So if you see, the interest and the preference dividend, these are fixed payments. The preference dividend rate is also fixed, and the interest rate is also fixed. So what I'm trying to say is the interest is always paid from the operating profit or profit from operations. Higher the profit from operations, the business will be in a better capacity to pay its interest or make its interest payments regularly. And that is why we are calculating interest expense as a percentage of profit from operations to see that since interest is being paid out of profit from operations, how comfortable the business is in meeting its interest expense. Because the moment profit from operations drop in any year for any reason, let's say the industry is going through a bad time, or let's say the firm is going through a bad time, there were problems in the firm, their revenues dropped, and so the profit from operations dropped. So in such years, will the firm be able to meet its interest obligations, or will it default on its interest obligations? This can be analyzed using the income gearing ratio. If this ratio, it means if the interest expense is a very high percentage of the profit from operations, it indicates that a big chunk of the profit from operations is used in interest payments. And in years when profit from operations even drop a bit, the firm will find it really difficult to meet its interest obligations. Or if it somehow meets its interest obligations, then nothing will be left for the equity shareholders. So a very high income gearing ratio is a risky situation, for a firm, from a bank, from a lender point of view, or from an owner point of view. A low income gearing ratio is good for a business, because then the business, has that room. If the profit from operations drop in certain years, the firm can still make sure that it pays its interest regularly. Because the moment you stop paying your interest, then you come under the default, you come under the category where you've defaulted on your obligations, and that is not a very good sign for any business. And if you think from the banker's point of view, banks will also be willing to lend you more in case you need money. If the firm needs more money, bankers will be only willing to lend you more if the income gearing ratio is on the lower side, because then the bank knows that, okay, if interest expense increases further from here, firm will be in a decent position to pay its interest, given that profit from operations are high. But if income gearing ratio is already high and less, room is left for making more interest payments from the existing profit from operations, bankers may refuse to lend more. How can the firm improve its income gearing ratio? Obviously, it will have to make sure that the debt levels are reasonable. The moment you start taking a lot of debt, your interest obligations will obviously increase, and income gearing ratio will go on a higher side, and that's bad. So it will worsen, the situation will worsen. So one can ensure that one has to maintain lower debt levels in the business, and so that interest payments are within the limits. And the second way in which income gearing ratio can be improved is you increase your profit from operations. You try to maximize your revenues, try to make sure that margins are good, try to reduce your operating expenses. All this will have an impact on the profit from operations. If profit from operations increase, automatically income gearing ratio will come on a favorable side, will reduce, and that is good for the business. The second ratio is the gearing ratio, which is a measure of the firm's financial leverage. So what do you mean by financial leverage? So first, let's see the formula. Gearing ratio is calculated as fixed cost capital divided by the overall capital employed. So overall capital employed consists of two: the equity part, where it includes the equity share capital and the reserves, and the fixed cost capital. So in the numerator, we have fixed cost capital, while in the denominator, we have the overall capital employed, which is equal to the equity plus the fixed cost capital. Now, what is fixed cost capital? Fixed cost capital is that capital on which the firm is supposed to make or give returns to the investor on a fixed rate. For example, if you've taken a loan from the bank is expecting you to make interest at a certain rate that is pre-decided. Same way, if you've issued preference shares and you've taken money from preference shareholders, the preference dividend rate is also pre-decided, it is fixed. So the loan taken from a bank, or money borrowed from debenture holders and money taken from preference shareholders, all these carry a certain fixed rate, and the business is supposed to pay these investors or lenders a certain rate on their investment, and that rate is fixed. So that's why these components of capital are called fixed cost capital, where the firm's obligation to service these funds is fixed. While equity, the dividend rate is not fixed. In years when profits are high, shareholders will expect the company to make higher dividend payments, and in years when profits are low, automatically the company will prefer to make lower dividend payments. So the rate at which the equity shareholders or ordinary shareholders are paid dividend is not fixed, and that's why equity does not come under fixed cost capital. Now, so this is a measure of financial leverage of the company. What do you mean by that? Imagine a firm that has taken a lot of fixed cost capital, and on that, let's say a firm has taken 6% loan, a lot of loan at rate of 6%. Using this loan, it is trying to maximize its revenue, its margins are good, so a lot of profit is being made, and out of this big chunk of profit, a small part is just paid as interest. So who is at benefit here? The ordinary shareholders are at benefit, because the company is taking money from an outsider, use that money really efficiently, and out of the profits generated, a small part is paid as interest. So whatever remains belongs to the ordinary shareholders. So ordinary shareholders are really happy. And why has this happened? Because to run the business, the company or the firm has not only depended on the ordinary shareholders' money, but it has also depended on the outsiders' money, on which only a fixed rate of return has to be paid. Versus ordinary shareholders, if you see, if you make higher profits, you have to pay them, you have to give them decent returns. But for a bank loan, the rate of interest is fixed. So this concept is called financial leverage, where a firm will take up more capital on which the rate of return is fixed, use that capital really efficiently, and once the profits are made, it'll meet the fixed cost obligations, and then whatever profit is left, that belongs to the ordinary shareholder. This is called financial leverage. So gearing ratio is a measure of the firm's financial leverage. How much of its overall capital is financed by fixed cost capital and how much is financed by the ordinary shareholders' money. So gearing ratio is a measure of that. Now let's see how to analyze the gearing ratio. I told you, if the gearing ratio is high, it means that a firm has taken a lot of fixed cost capital. If you think from the firm's point of view, it is good. High financial leverage is good if the firm is able to use that money efficiently and make profits and generate profits. But in years when the money is not used that much efficiently and the firm's profits are not high, what will happen is the interest on that loan or the fixed cost capital still has to be made. The bankers will not listen to the firm that this year was not a good year, we did not make sufficient profits, interest still has to be paid. In this case, the firm may even show up a net loss in the income statement because profit from operations are really low, but interest expense is not going down. So there may be a net loss at the end of the year. So a high gearing ratio can be highly rewarding also, and it can be very risky also. And that is why a very high gearing ratio indicates a risk to the lenders, especially if the firm wishes to increase its fixed cost capital. Currently, most of the firm's capital is financed through fixed cost capital, and if the firm wishes to take further more loan from the bank will really think once, because if the gearing ratio is already very high, it shows a very risky situation already. Because in business, there is uncertainty. If the previous year was a good year, doesn't mean that every year the firm will be able to generate guaranteed profits of the same level. So the bankers may have to think twice to lend to a firm that is already having a high gearing ratio. And how can one improve this ratio? Again, maintain reasonable levels of debt. So if your overall capital requirement is a certain amount, a certain percentage should be taken as fixed cost capital, and one should not increase that limit. One may argue that why to even take up fixed cost capital, because that poses some kind of risk. The moment you take up a bank loan, whether you take up a small amount or a big amount, there is some kind of risk element involved, because interest payments have to be made definitely, whether or not profits are earned or no. And even the bank loan has to be returned as per the agreement with the bank, whether or not profits are made. So why to even take up that fixed cost capital? Why not only depend on the ordinary shareholders' money? See here, if you do that, the returns to the ordinary shareholders will not be maximized. Think from an owner point of view, think from a person who is running a business. If you have to run a business and your business is solely dependent on your investment, your growth rate will be low. Because if you don't have the necessary funds to expand your business, you will have to wait for a few more years until you make up that profit and then reinvest that profit into business. But if you are allowed to take up a certain amount as bank loan, you can quickly expand your business by borrowing, making money and repaying the money to the bank, and overall enjoying high growth rate and high profits as an owner of the business. So that's the advantage of having some kind of financial leverage versus not having any financial leverage. But yes, the financial leverage should be in control, because a very high financial leverage or a high gearing ratio is definitely not good for any firm. Now let's look at some of the investment ratios. Under the investment ratios, the first one is the earnings per share, also called EPS commonly. EPS is calculated as the profits that are attributable to the equity shareholders or ordinary shareholders divided by the number of ordinary shareholders. How do you calculate the numerator? So once you get the profit from operations, in the previous slide also I told you, first you have to pay the interest, then you have to pay the preference dividend, and whatever remains, that belongs to the ordinary shareholders. So we are talking about this value or this amount. After making the payments to the debenture holders or the bankers and the preference shareholders, whatever remains, that profit is called profits attributable to the equity or ordinary shareholders. That has to be divided by the number of ordinary shares in the firm that are already issued, and then we get the EPS. So EPS is basically a value in amount, because profits are in amount, that divided by the number of ordinary shares. So let's say we get $2, so it's $2 per share. This is how you present it. How do you analyze EPS? See, you cannot compare EPS of two firms, because for every firm the face value of the share is different. The level of investment in the firm is different. The level of revenues, the margins are different. So EPS for two firms cannot be compared directly. But yes, you can compare the EPS of a firm of its current year with that of the previous year to see that compared to the previous year, is the firm able to make more money for its shareholders in the current year compared to any of the previous years. That way EPS can be compared to the previous year's value, previous year's EPS. How can the firm try to improve its earnings per share? Obviously, to work towards maximizing the profits, maximizing the net profit, and hence profits attributable to the ordinary shareholders will automatically increase. Then we have the price earnings ratio, also termed as PE ratio. So how do you calculate this? You will take the market price of the share and divide it with the earnings per share, EPS, that we just saw. Market price of the share, if the firm is a listed firm and the shares are available for purchasing in the stock exchange, then you will get the market price of the share from the stock exchange. The share would be quoted in the stock exchange, and you can use that market price. That divided by the EPS, you get the PE ratio. Now understand the concept of PE ratio. What do you mean by PE ratio? So let's say I'll give you examples of two firms, A and B. Both these firms are in the same industry. The market price of firm A is, let's say, $20. You can buy the share of firm A for $20, while you can buy the share of firm B for $50. A person who does not have sufficient knowledge of accounting and finance, he would compare the price of firm A and firm B and comment that the shares of firm B are expensive, and then hence it's not worth investing in the in firm B. It's not worth buying the shares of firm B because obviously the price of firm B shares are higher. But this is not the correct way of making comparison of the share price. You have to look at the PE ratio. So let's say firm A, for every share that the shareholder owns, it is making able to earn an EPS of $5 for the shareholders. So if you own one share of firm A, you are getting an earning of $5 every year per share, while firm B is able to generate an EPS for its shareholders of $20 per year. So every share of firm B you hold, you will get $20 earnings during the year. You will be able to, your firm is earning for you $20. Now if you compare the PE ratio, for A it comes to 4, while for B it comes to 2.5. What does this mean? It means that to earn $1 earning in firm A, you have to pay a price of 4, because $20 divided by $5. So for $5 earnings, you are paying $20 price. So for $1 earning, how much price are you paying? You're paying a price of 4. So 4 for every $1 earning. While for company B, you're paying a price of 2.5 for every $1 earning that you're expecting from firm B. Now tell me which firm is having a expensive share, or which share is more expensive, firm A or firm B? Definitely firm A, because to make $1 in firm A, you'll have to pay a price of 4, while to make $1 in firm B, you'll have to pay a price of 2.5. From an investment point of view, it doesn't matter who helps you earn that $1, whether firm A or firm B, but you will be looking at what price are you paying to get that $1 from any firm. So overall speaking, PE ratio tells you how expensive the price of the share is for any firm. So looking at this, you might conclude that, okay, if the PE ratio of a firm is lower compared to some other firm, it is better and we should invest in that firm. More or less, maybe yes, sometimes no also, because PE ratio can be high or can be low for various reasons. For example, if A and B, if both are in the same industry, why are investors ready to pay a higher price for shares of firm A? Think about it. Maybe because the quality of the products of firm A is better. Maybe the management is efficient of firm A. Otherwise, why would investors pay in the same industry pay a higher price for a firm if the shares of other firm are available at a cheaper price? They will pay a higher price because maybe of the inherent strength of that firm compared to other firms in the industry. So though the high PE ratio of a firm shows that the shares are expensive of that firm, but maybe in the long term that firm will do better because overall the investors are expecting better performance from that share. So just saying that one should invest in shares of a firm with a lower PE, that may not be correct, or one should invest in the shares of a firm with higher PE, that also may not be correct. You will have to do your analysis before deciding where you want to invest. Overall, if you see if both firms are almost at the same level and the products and the quality of management of both are fine, then one should try to invest in a firm with a lower PE so as to make better returns in the long term. So if you see here in the analysis, a high PE ratio means that the price of the share is expensive and the gains to the shareholders may be limited. Yes, if you're buying something expensive, your returns on that investment will be limited. However, it also indicates that shareholders may have higher level of confidence on that firm, and hence chances of that firm outperforming its peers are higher. And then we have the dividend per share. In this, we will calculate the ordinary share dividend paid by a firm divided by the number of ordinary shares under issue. So very simple. If the firm has overall paid, let's say $50,000 as dividend during the year and 100,000 shares are under issue, so $0.5 will be dividend per share. So it shows you how much dividend will you get from the firm if you own one share of that firm. So when analyzing dividend per share, you may compare it to the previous year's dividend per share of the same firm to decide whether what's the trend of the firm, whether is it increasing the dividend per share over the years. If yes, maybe the firm is following a high dividend payout policy. But if the dividend per share over the years is reducing, if the trend is it's a downward trend, then you'll have to see what are the reasons for it. Is it because the firm is reinvesting most of the profits for its future growth, or whether the profits of the firm are reducing and that's why dividend per share is reducing? That will have to be seen. And then we have the dividend yield, which measures dividend as a percentage of the market price of the share. So let's say if you have paid a price of $50 to buy the share of a firm, and if the firm is paying you, let's say $2 as dividend for the year. So this ratio calculates what the dividend is, how much percentage of your overall investment in the firm, which also makes sense because whenever you invest your money somewhere, you also want to know that what percentage of my investment am I getting back as returns on an annual basis. So this dividend yield helps you to calculate that. So $2 divided by $50 into 100, you'll get 4%, which means dividend yield is 4%, and you're making 4% of your investment every year as dividends only. A company with higher dividend yield may be preferred by shareholders who are expecting higher dividend on their investment. But shareholders who are expecting more growth from the company, they don't want dividends to be paid out currently. They want higher growth from the firm. For such investors, they may be looking. They don't mind having a firm with lower dividend yield, but they obviously expect the company to grow at a very fast pace. And then finally, we have the dividend cover that measures the comfort level of the firm when paying its dividend out of the profits attributable to the ordinary shareholders. See, look at the first formula here. Profits attributable to the ordinary shareholders is divided by the dividend paid. So this calculates the dividend cover in times. In other words, it tells you how many times is the current profit that belongs to the ordinary shareholders is covering the dividend paid on ordinary shareholders. This may be important for shareholders because currently the dividend paid by the company is good, okay, but if the dividend cover is low currently, and in future, in any uncertain event, if the profits of the firm fall, and obviously the profits attributable to ordinary shareholders will also fall, in such years, how will the company be able to maintain its current dividend levels? Obviously, it will not be able to maintain if the dividend cover is low, if the current levels of profits are not covering the dividend payments sufficiently. So in that case, the shareholders may be cautious, and if a shareholder is very specific about receiving certain dividend yield, then they may want to avoid investment in firm with a lower dividend cover, and they want to make sure that the firm is really comfortable in paying its dividend at present and in future. Alternate way of calculating dividend cover is if I divide the numerator and the denominator by the number of shares, both the numerator and denominator. What do I get? Profits attributable to ordinary shareholders divided by the number of shares. I get the EPS. And the dividends paid on ordinary shareholders divided by the number of shares, I get the dividend per share or DPS. So if in the question EPS is given and the DPS is given, you can divide that also to get the dividend cover. A high dividend cover is preferred as it may give confidence to the shareholders that the dividend payments that are being done currently, that can also be made by the firm in future, even if there is a bad year or maybe the entire industry is suffering from some event, or maybe a recession in the economy. In all such events also, the company can continue making its dividend. Currently whatever dividend is paying, it can continue making those dividend payments. A very high ratio, however, may be may lead to an element of caution for some investors, especially investors who want the company to grow at a very high rate, a high pace. So they would expect the company to follow a conservative dividend policy and invest most of its profits back in the firm to ensure that the company is expanding across borders and making sure that it grows very fast. So depends what is the investor's preference here, and accordingly they will analyze the dividend cover. So that completes our second part of the ratio analysis. I hope you've understood the ratios. Again, using these ratios, these formulas, you will have to practice a few questions to get a good grip on ratio analysis. Just by watching this video, you may not be able to do the questions properly in exam. So make sure you practice a lot of questions, past paper questions. You can use these formulas, and I think you'll be fine. And then you can read the analysis that is given in the marking scheme to see how the analysis is being done in the marking scheme. Try to learn from that analysis, and then you can use the same kind of format and the analysis in the exam also. If you enjoyed the video, please like the video, subscribe to the channel, and share the video with your friends. I'll see you soon in the next video.